Guys, it's Canadian Kyle here at the Wealth Holders Podcast, and today I'm joined with Alex Pernin. He's the CEO of Star Royalties, one of the newer royalty companies on the block. Ticker symbol is STRR on the TSXV. Alex, how you doing?
I'm well, Kyle. Thank you. How are you?
Doing good. Where are you calling in from?
I'm in lovely Toronto, Canada, just outside of the offices, working from home here.
There you go. Yeah, Thunder Bay, Ontario for myself. So, Alex, I always like starting off the interview asking the same question to each of my guests. What were you doing when you were my age? I'm 25 years old. So what were you doing from 20 to 25?
20 to 25. That's an atypical question for the interviews, but I like it. Early 20s, I would have been still in university. Then mid 20s working. I started off in astrophysics, out of all things, in university. Yeah, I was passionate in space and theoretical physics, nuclear physics, particle physics. Something that I've always been into. I still am to it. It's still a passion of mine. So I started off university in that. I think I had an epiphany in second or third year that as interesting as it may be, my job prospects would be limited. I'd be working, well, the idea at that time was academia, so I would have gone for my PhD and I would have worked either at the university or at a planetarium or a space agency or something like that. And anyways, I realized that work-wise might not be the most logical fit. And in astrophysics, there's planetary science as well. And I thought, okay, well, maybe there's a natural fit in geology. I was studying at University of Toronto. I was in Toronto, so it was one of the mining capitals of the world. And I thought maybe segueing into geology might make sense. So I got into geology. I finished my undergrad in geology. In terms of work experience at that age, I had my first geology job in central Quebec. Okay. I was working for a gold exploration company. They're still around, Northern Superior Resources. I was working on their Croteau Est gold project in central Quebec and Chibougamau area. So I spent a whole summer there, and it was very early greenfields work. We were doing soil sampling, SGH sampling. We did some trench mapping. So, really learned the industry from the early stages of exploration. And then the next job I had in my early 20s was in production. I was an open pit geologist for a large copper producer called Freeport-McMoRan. So I was working in the US at that point. I was based in New Mexico, but I spent a little bit of time in Arizona. And I was working for one of their larger copper operations. It's called Chino. As a production geologist, you're doing blast hole sampling and surface mapping and all sorts of fun production geology work. So I did that for a bit. I came back to Toronto and I did my master's in economic geology. I actually did my master's on the project I worked for with Northern Superior Resources. So I went back to Quebec. I did my thesis on their deposit. I was looking at mineralogical, geochemical, structural aspects of geology with this deposit. And I recommend doing a master's for the younger audience out there, doing a master's on an industry project. I think it just helps with work potential out of university. But anyways, I did my master's in that. And the funny thing is, I started my master's thinking I would work for a mining company. I had an exploration mining background and doing a mining thesis, but I ended up meeting a couple of bankers. One was from TD and one was from Goldman Sachs. And I learned about the finance side of the mining industry. And I thought, well, this is pretty cool. I didn't know this was a thing. It's not something that you're taught when you're doing a technical scientific degree. But I really liked what I heard about it. And that's how I segued into mining finance. I worked for an investment bank called Canaccord Genuity. I worked there for a few years. I was in equity research and I was covering junior to mid-cap gold producers. I was also covering royalty and streaming companies. So I had always known of the royalty and streaming companies, but I never analyzed them. I didn't understand their mechanics. So this is how I was introduced to the industry and fell in love with it. I actually interviewed with one of the companies. I was too junior for this role. It was quite a senior role, but that's how I knew I really wanted to get into the royalty space. So anyways, that's past 25 at that point, but I ended up working at Barrick Gold after that. I was on their investment management team, which is a pretty interesting role. It's like corporate development, but you are not only externally looking at opportunities. The typical corporate development role is M&A. You're looking at opportunities that you can buy or opportunities where you can sell your assets. And what we were doing at Barrick was capital allocation. So essentially, if you have $1 billion, how do you spend it? Do you go and buy an asset? Do you go buy a company? Do you go and invest it in one of your projects? Do you buy back your shares? Do you pay a dividend? What's the best way of spending your money? And it was a really interesting role because not only did we look at all the external opportunities, but Barrick had a massive, and still has obviously, a massive portfolio of assets, and on the green fields and the brownfield side. So it was a neat way of learning how to allocate capital amongst 200 opportunities, and that segued into Star Royalties. So, anyways, that's 20 to plus 25. But that's what I was. That's what I was doing at your age.
Thanks for the in-depth explanation. I always like learning about the people and what they did in the past to get them where they are today. And you said that segues into Star Royalties, but can you elaborate more? Like, how did you come of how did Star Royalties become, and what about your other teammates? What experience do they have, and what do they bring to the table?
Right, good question. So let's go back to Barrick for a second. At Barrick, we had worked on two major transactions. We had done the Randgold acquisition. It was the largest gold acquisition in over 10 years, $5.5, $6 billion US acquisition of that company. And at the same time, it was a very busy year, we were also forming what is now called Nevada Gold Mines. It was a joint venture between Barrick and Newmont with all their Nevada assets. With the Randgold acquisition, that was a natural segue to be leaving Barrick and move on to another opportunity. And at the time, I actually was looking at doing a very similar job to the one I had at Barrick, but at a base metals company. It was to go and establish a capital allocation team and do the same thing I was doing at Barrick, but at this large base metals company. But in terms of the team and who's involved, that's the funny thing. Star Royalties, the way I describe it is it's a new company, but it's an old team. So all the people that are involved, there are 5 of us, apart from Ken, who's our CFO, who joined recently from Franco-Nevada. The other 4 partners were people that worked together since 99, I think, 99, 98, 2000. So it's a group that's been working together for a very long time. We've not only been working together, but we worked well together. And there was an opportunity, no pun intended, but the stars aligned that we were all available at the same time. And we rejoined forces in early 2020. We had a unified vision of what we wanted to build with Star Royalties. We wanted to build this company from the ground up, and we could talk about the merits of how we built it up and the thought process behind it. But we knew what we didn't want to do. We knew what we wanted to do. So we joined forces in 2020, and 2020 was a year of getting the team together, getting the board together, kind of figuring out and designing what the business model would be exactly. And that was the birth of Star Royalties. So since then, we were a private company last year. We're now public. Since then, we've raised $44 million. We IPO'd in February of this year. Like you said, ticker STRR under the TSX Venture. We also trade in the US under the OTCQX STRFF. And really the business model, and I'm sure we'll go into more detail, but the business model for us is focused on originating new royalties and streams. That's the background of the team. We're all coming from mining finance backgrounds. And what we wanted to do was build up this portfolio of assets, progressively build it up. The emphasis would be on low risk. The whole thing with this team is low risk, low cost. We want to be the lowest cost G&A company on the street on the royalty and streaming side. Focus on cash flow, because at the end of the day, you need cash flow for a business. And we also wanted to focus on quality and value over quantity. We're not looking to build a massive portfolio. We want to build a high quality portfolio. And that's basically Star Royalties 101.
Okay, thank you for that. What I'm interested in Star Royalties because of this. You're going right out of the gate with royalty and stream creation, deal creation. And I only know of one other company doing this. So I'm just wondering, I've had many royalty companies on the podcast, and a lot of them started third-party royalties. They say that's the way to do it. You start with third-party royalties, and I think they say that because if you look at the success stories of today, that's how they started, and if you look at the history. But do you have a rebuttal for this?
Absolutely. I mean, there are multiple reasons why we think we're different, and we can get into those details. There's obviously the team, and we haven't really spoken on the team, and there's the alignment, and we'll speak about the alignment. But one of the differences is the underwriting aspect, right? Coming in and underwriting. There are multiple reasons why we think it's the better way to go. The first one is that it's a proven business model. If you look at the major players in the royalty space, you have Franco, Wheaton, Royal Gold, Cisco, Sandstorm. You now have Triple Flag in the mix, but you just talk about those 5 companies. That's the business model that they have. They are capital providers to the industry. They raise capital, they have debt, they have redeployment of cash flow, but at the end of the day, they are allocating capital to opportunities, whether it's exploration, development, producing. So they are underwriting stories, and that is the success of the royalty and streaming business model. They've been around for 15 years. Now we have several new entrants that have been very successful, but the founding father companies, if you will, are underwriting companies. And at the end of the day, that's what we want to be. We want to be that on the smaller scale. Eventually, we'll build ourselves up, but there's an opportunity to underwrite on the smaller scale. And one way to describe it is we are a royalty and streaming company. We are not a company that owns royalties and streams. And those are 2 different things. So point number 1, it's a proven business model. The second point, and I alluded to it a little earlier, our background is financing. We're all mining finance people. Kevin McLean, as an example, he's our chief investment officer. He has a 30-plus year track record of capital deployment as a portfolio manager. He's one of the most successful Canadian precious metals portfolio managers out there. My experience from Barrick, everybody on the team has a background of deploying capital and investing in different opportunities. Our whole thing is optimizing our counterparties' risk-adjusted cost of capital, right? And I think that's also different because we're coming in with a shareholder perspective. We think about it in the sense of, if we were a shareholder of this counterparty, what kind of deal would we want to see structured? And that's the basis of how we structure our deal. So our background is biased in financing opportunities. If you think about financing, we're coming in with a new form of competitively priced financing. That's what we're doing with these royalties and streams. And we're focused on the smaller end of the sector. The smaller end of the sector has been capital starved for nearly 10 years now, if not longer. So these origination type opportunities that we're working towards represent a much larger pool of opportunities than what you typically see in the already defined existing royalty space. Not that there are so few royalties out there that are existing, but when you're deploying capital, especially for smart deals, you have a much larger and much broader horizon of opportunities. You also have to think about benefiting the underlying operator. When you underwrite a deal, you're providing capital to the underwriter, to the underlying operator of the asset, right? You're benefiting the financial health of the operator. If you buy a third-party royalty, the company that acquires it, the royalty company, will benefit. The vendor of the royalty will benefit, but the operator of the asset doesn't see any cash inflows, right? So by us providing capital to the operator, they're either repaying debt and cleaning up the balance sheet, or they're using it for exploration, or they're using it for optimization, expansion, potentially acquiring another asset, but they're using money to put it in the ground. So if they're spending that money that you're giving them on their own asset, that's self-serving. You're benefiting the asset that you're getting cash flow from. The other thing to keep in mind too, and this is something that we like to talk about, is due diligence. Due diligence is a critical part of the job, right? You need to understand exactly what you're acquiring. You, Kyle, as an investor, need to diligence the companies that you're going to be investing in. It's the exact same thing from our point of view. We have to diligence our investments. When you are underwriting, you have a direct dialogue with the operator, right? You're having a conversation, you're here to provide capital. So it's an open book when it comes to diligence. You structure the terms and the returns as needed, which is different than a royalty that's existing because you get it as is. But when you get this full access to the due diligence, you can go to site, and it just makes it that much easier. You're not restricted like you would with an existing royalty, because with an existing royalty, you have limited public information, and sometimes it's not even a public company. So it makes it that much harder to diligence it. I'll give you an example. Copperstone, which is our largest asset at the moment, it's an $18 million US gold stream. With Copperstone, we spent over 1,000 man hours of due diligence. We had a full technical team review the asset on top of our own time reviewing it. We had a team of exploration geologists, resource geologists, mining engineers, metallurgists, cost experts, environmental experts. So we had a whole group that diligenced the asset. They went to site, they provided a whole technical report for us. You just don't get that same access to information when you're acquiring a third-party royalty. And the last point is that it's competitive. Like you said, there are a lot of peers out there. Not all peers focus on third-party royalties, but a lot of companies do, and it's a successful business model. A lot of them have done very well, but at the end of the day, it's becoming more and more competitive, and you are seeing in the space compressed returns when people are acquiring existing royalties or portfolios of royalties. They may be getting a minimal return. They may not be getting a return, and in some cases, they may get a negative return, and that's not what we're interested in. We're looking to get high return, high accretion deals here.
Right. Okay. Thank you. That was very, very nicely said. A lot of questions I have. I'm just trying to figure out where to ask first. I think I'm going to go with the due diligence part. You say there's a lot of due diligence required, and I agree, because you have to know the partners, but you also say not quantity over or quality over quantity. But how many deals do you expect to do in a year? How many would you be happy with on an annual basis?
That's a great question. So last year in 2020, we seriously diligenced, I'd say 7 or 8 opportunities. And it was a range of everything: cash flowing, near cash flowing, geographically diverse. And different opportunities didn't pass the test of diligence for different reasons. One opportunity, the contractor mining was inadequate for the operation. It wasn't properly sized for the stope size of the underground operation. So that's an opportunity that may come back. We actually provided them advice in who they should be using as a contractor, and I believe they listened to us. So that might be an opportunity that we come back to, but that was a pass at the time. We were looking at an opportunity in West Africa. It was in Burkina Faso. This was a multi-billion-dollar company that was vending a royalty, and we had a relationship with this company. Interesting royalty, interesting asset, interesting geology, but just change in geopolitical climate there, especially last year, was fairly significant. So we decided that we weren't able to tolerate the risk, so we walked away from that. Anyways, there are other opportunities that we diligenced and just decided not to progress with. But out of the 7 or 8 opportunities, we transacted on 3. We transacted on the Copperstone stream. We transacted on an existing royalty on the Keysbrook mine in Australia. It's a mineral sands asset, and we bought that from a large private equity group called RCF. We also transacted on our first carbon offsets credit royalty, which I'm sure we'll chat later on. But in terms of an ongoing basis, I think that's something that we would want to target at least 3 or 4 acquisitions per year, and they'll vary in size. We just announced one a week ago, and it was a small acquisition, but it checked off all the boxes, as it was another carbon offset credit royalty. Some other opportunities we're looking at are $5 to $15 million US, and they will progressively get bigger. I mean, that's part of the strategy, is deal sequencing. You want to have a logical manner in when you announce your deals, so that you can maximize your share price re-rate, right? You want to have a maximum benefit to your share price. And the idea there is that we have a large pipeline. Our pipeline is at least $200 million US now, and these are all opportunities that we'll review progressively. It's not going to happen all at once, but out of that pipeline, there's some larger opportunities that we'll be reviewing later this year and into next year. And we want to make sure that we are well positioned from a cost of equity perspective, cost of debt perspective, making sure our cost of capital is optimized before we start doing the larger deals. So for us to do that, we are hoping to announce these smaller deals. Not that they're smaller. $10 to $15 million US is still a significant deal for us, but they're not as large as the larger deals that we're looking at later on next year.
Okay. So you said $200 million pipeline. You see rather blue skies for the creation side of the space right now? Like, I'm just trying to see, how do you remain competitive if this is exclusive, this pipeline, or if you're going to be competing with these deals?
That's right. So on the pipeline, one of the benefits of the pipeline is that it's, for the majority, not all assets, but for the majority of it, it's exclusive to us. So maybe we'll talk about the team first, because that segues into the pipeline, and that might make a bit more context. I think one of the benefits of the company, one of the main selling features, if not the selling feature of Star Royalties, is the team. Now, if you think about it as an investor, you have several royalty and streaming companies to decide upon which you want to invest in, right? As Canadian Kyle, the investor, you have especially now, many more royalty and streaming companies that you have to diligence and decide which one you want to invest in, right? In the last 14 to 16 months, we've had significantly more royalty companies than we did 2 years ago. So you have to figure out which is the best one that I want to invest in. And I think one of the best ways to figure that out is the team, because at the end of the day, the team that you are investing in is the primary asset of the royalty and streaming company. A royalty and streaming company is essentially a team of capital allocators that are provided capital, and then they have to decide based on their experience the best way to reallocate that capital, right? Redeploy the cash that you've provided us into high return deals. So the team is, I think, one of the best in the industry. It may sound biased, but I really am proud of this team. It's a team of very seasoned and respected members of the mining industry. There's a track record of successful capital allocation, of risk assessment, like we were saying with Kevin. Kevin has been awarded, I believe, 13 Lipper Awards and 7 Top Gun Awards. He's got the most Lipper Awards of any Canadian portfolio manager in Canadian history. So it's an impressive feat. And because of that, we have the management team itself has over 100 years of experience from everything in the mining industry, from portfolio management to equity research to corporate development to mining operations. Now, because of that experience, the team has deep relationships. And not only do we have deep relationships with the industry by providing capital to them over the last 20 to 30 years, but we also have a deep asset knowledge base. We know which management team is which, what company is doing what this asset was not only 2 years ago, but 20 years ago. So by having that knowledge base, we are successfully leveraging that to build our pipeline of opportunities. And because these are a lot of opportunities that we've been deploying capital to, these are relationships that we've had over the last 20 to 30 years, that pipeline is for the most part exclusive to us because they trust us. They know that we've been here, we've been their shareholders, we've been deploying and financing capital for them for a very long time. And that's what's led to this $200 million portfolio. Like I said, it's going to take time to progress, but having a pipeline, by having a pipeline that's mainly exclusive to us, I think that is another selling feature. That itself is unique by having a pipeline that most companies are not aware of. And that also goes to the underwriting. When you're underwriting, the beauty of it is most people don't know about it, right? You're having a discussion in confidentiality with an operator about their financial requirements. It's not like it's a process that's being run by the bankers and everybody on the street is aware of it. It's something that's exclusive. So that's something that we're hoping to do more and more of. The deals that we've done so far have been exclusive. We've seen a bit of competition on some deals, and the opportunities that we're currently advancing are all exclusive to us, and we're looking forward to announcing them in due time.
Okay, thank you. And one thing that caught my eye when I was doing my due diligence on Star Royalty, and you talk highly of Kevin, so I watched his interview on Crux Investor, and I thought it was interesting that he opted out of a salary, and he's much more, the team's focused on stock performance over salaries. So with that, are you looking at a dividend in the near term? Like, are you focused on, or would you rather build up the portfolio, or like how soon of a dividend are you thinking?
Right. So let's speak about the alignment first, and then we can talk about the dividend. And the dividend is an important part of the story. One of the distinguishing features is the superior alignment. That's something that was important to us day one. The whole team, we're all long-term students of the royalty and streaming sector. We've been vocal critics, especially Kevin, Tony, myself included, but not as much as the other members, just given that they're a bit more seasoned than I am. But we've all been critics of the industry, whether it's poor alignment to shareholders, poor capital allocation practices, sometimes capital destruction, actually quite often capital destruction, excessive management compensation. You know, we had a list of issues that we have with the industry, and we wanted to make sure that we stayed away from all of that. We wanted to create we wanted to create the company the right way. That was the opportunity when we started Star Royalties, and that was proper alignment to shareholders, proper governance, and an equity-driven approach to building up the company. So when we talk about equity, and Kevin, in the case of no salary, skin in the game is crucial to drive alignment, right? That's how you get alignment between the management team, the directors, and the shareholders. Something that we're very proud of is that the ownership of Star Royalties that the management team has, and we own about 7.5% of Star Royalties, that ownership was gained by directly co-investing in all of the financings that STAR has had. We had a few financings last year as a private company. We all participated. We participated in our IPO financing earlier this year. So the point of this is that where sometimes you see other companies, and not just in the royalty space, of course, companies in general, when they have a fairly large ownership, you have to ask yourself, was that ownership earned? Did they acquire it, or was it given to them? Was it gifted to them? So that's something that we're very proud of. The ownership of Star Royalties by our team was earned directly with our hard dollars. We bought that ownership. Now, in Kevin's case, Kevin is committed to never drawing a salary. It's a bit unusual, and you typically don't see that from an executive officer. But that's what he wants to do. He wants to be completely aligned with his shareholders. I believe he spoke to that at the Crux interview. In terms of the dividend policy is something that we've always spoken about, and it's an essential part of the business model. It's something that we will announce, but it's something that will take time. For us to do that, we want to make sure that we establish a sustainable and healthy amount of cash flow for it to be a sustainable dividend, right? Yeah. We'll likely target about 25% of our free cash flow as a dividend policy, and that will happen in time. I'm uncertain if that's going to be next year or the year after that, and it's subject to change depending on the opportunities that are in the pipeline that will transition to the portfolio. But that's something that we're going to want to do. You know, we are taking very low cash salaries. We're being remunerated in equity and RSUs and options, and dividends will be a major component of how we get compensated. So that goes back to the alignment. The way our shareholders will be compensated with share price appreciation and dividends, it's the exact same thing with us. So we just need to be established enough to be able to pay that dividend and make sure that it's sustainable going forward.
Yeah, don't want to rush it for sure. Another part of your strategy is carbon offset credit. So I'd like to get into that. First of all, what is a carbon offset credit, and why does Star Royalties see value in it?
Right. So Kyle, maybe I'm going to explain why we're involved on the green side first, and then we'll speak about the carbon credits. The carbon credits itself, that's a fairly in-depth discussion. Mm-hmm. But the reason we're in carbon credits is because we want to be involved on the green side, right? So we get asked a lot, why are we so focused on green, you know, and eventually why are we involved with carbon credits? But on the green side, we announced our first carbon credit deal last year with the Laxal First Nation in Northwestern Ontario, not too far from where you are. Very good. So that was our first carbon credit royalty. As far as we understand, it's the first carbon credit royalty out there. And the reason we wanted to get more and more involved on the green side, the first one is pretty obvious, is that we see a significant and disproportionate amount of interest and demand from shareholders for ESG and green investments. We saw it last year as a private company when we were doing our private raises, especially when we announced our deal, but it was evident when we were doing our IPO in February. Every single meeting we did in our IPO, people asked about carbon credits, people asked about the green strategy, people asked about ESG. You saw funds, especially in the last year or so, become a lot more rigorous when it comes to their ESG measurements and demands. You know, it's all about quantifying your ESG investment now, especially out of the UK and Europe. You're seeing it in North America as well, but Europe is far more advanced. You know, your water usage, your greenhouse gas emissions, your gender diversity, your management compensation, they are actually quantifying these things, and sometimes they're even being penalized for doing non-ESG investments. Because of that, you're seeing a rapid growth in ESG funds from everything, assets under management, ESG ETFs, ESG debt like green bonds. You're seeing ESG money inflows everywhere, and it's getting exponential. It's quite impressive. Even from an individual perspective, you know, you're a young guy, and I'm sure the audience can be quite young. A lot of people are considering their carbon footprint, right? And they are even paying premiums for corporations that are actively engaged in carbon neutrality. I'll give you an example. At the grocery store, I bought some chicken, and then the packaging says, you know, this is a carbon neutral company. I've never seen that before. That wasn't a thing that existed a year ago. So it's really ramping up. In terms of scalability, you are seeing a significant amount of green opportunities out there, right? It's something that we see from a carbon sequestration aspect, from green tech that's displacing fossil fuels, from renewable energies.
It's a very scalable business model. There are a lot of opportunities there. And not only are there a lot of opportunities, but the investment returns are quite attractive. They're actually superior to what we see on the precious metal side. These green deals so far at the moment have superior internal rate of return metrics, NAV accretion metrics, cash flow per share metrics. These green deals are very attractive. And it's also a bull market. That's not the reason why we're involved on the green side, but it certainly benefits it. You're seeing an acceleration in carbon offset credit prices, both on the compliance and the voluntary markets, and I'll explain what that is. But compliance carbon offset prices are at all-time highs globally, and especially in Europe. That's what's driving these global prices. Even in Canada, if you look at the federal government of Canada, in December of 2020, they had this announcement about the ongoing increases in carbon prices, this carbon tax that we have. Right now, carbon prices are $40 Canadian per ton of CO2 equivalent. Those prices will go up to $50 next year. And the Trudeau government announced further increases of $15 every year, from $50 all the way to $170 a ton by 2030. So that's the background as to why we're so involved on the green side and why we're ramping up the green side. Now, to answer what carbon credits are, how that works, we first need to talk about the Paris Agreement. The Paris Agreement is an international treaty on climate change. It was adopted in 2015 in my hometown of Paris. It was signed in 2016 by 196 nations. And the purpose of the treaty was to reduce global greenhouse gas emissions. It's a very straightforward objective. The specific goal is to limit global temperature increases to below 2 degrees Celsius above pre-industrial levels. And there's a secondary aggressive target of limiting that increase to 1.5 degrees. It's fairly aggressive, but it's something that we have to do. Now, because of that, you have governments that are constantly increasing their commitment to reducing greenhouse gas emissions. You've got over 100 countries now that are doing that. You've got over 1,000 corporations that are committing to major greenhouse gas emission reductions by 2030, and a goal of being completely carbon neutral by 2050. And there are multiple ways of achieving these reduction targets. One way is to completely emit your emissions, just stop emitting. That's not very practical. Another way of doing it is to transition to technology that offsets it or displaces it, like a renewable technology. And that is the answer of the future, but it's going to take time to do that. The other way to do it is to offset your emissions through carbon offsets. So to answer your question, what is a carbon offset? A carbon offset is anything that's generated from any activity that either prevents or reduces carbon emissions, like renewable energy, or improves carbon sequestration, like conserving the forest, like the 2 deals that we've announced so far. And one carbon offset credit is equal to 1 metric ton of CO2 emission reduction. Every carbon credit is 1 CO2 ton that's been reduced, right? And there are different types of carbon offset projects. You have things like biosequestration, which is what we've been involved with so far, improved forest management, avoided conversion of your forests in the Thunder Bay area, for example, to logging operations. You have something called regenerative agriculture, which is very interesting. You have renewable energy, of course, solar, wind, hydroelectric, geothermal, biomass, biogas. You have methane destruction as well. So that's what.
So is that all fair game for Star Royalties? Is that all fair game, all that stuff? Or like right now you said just reforestation, right?
I would say everything is fair game. I mean, we're interested in not only carbon offset projects, we're looking at other green tech that might be offsetting diesel usage. I don't think we're necessarily looking at renewable energies at the very moment, but that might change in the future. On the biosequestration front, there are a lot of opportunities. Anything in terms of forest conversion or regenerative agriculture, there's a lot to do there. So we're looking at the several opportunities on that front. And in the future, we'll see. I think we're going to want to diversify and not just have carbon credit opportunities. We'll want to have a diversified portfolio of green investments. So in the future, we'll see. We'll be looking at several opportunities.
And I heard about these blue carbon credits, something about water, reducing the carbon in water too. I don't know if you've looked into those yet or not.
That's right. Well, you can sequester carbon dioxide both on land and on water. You have marine environments that sequester carbon. We haven't looked at those particular opportunities, but we know that they're out there, and they may be of interest to us in the future. But on the land, in terms of boreal forests in Canada alone, there are a lot of opportunities, and that's not including opportunities in the U.S. and obviously other parts of the globe.
Okay. So I love the green approach, and you say ESG, and this has been a confusing spot for me in the royalty spaces, because the royalty model is such a mean and lean business model. You guys, it's an amazing business model, the royalty model, and people are saying yes, green energy, green everything, but a lot of people miss the S in ESG, I find, and I feel like it's an issue or should be dealt with more as a whole in the royalty space, the social, because you're so distant. You're in Toronto, and all these operations are, you're nowhere near them, right? But shouldn't you be providing back to the communities for the social aspect of things, education, things like that? Do you see that in the future of Star Royalties?
No, absolutely, of course. I mean, look, we're in our infancy and we're establishing ourselves as a royalty company. Our ESG investments will change. So that will obviously be a part of it. It's something that we review in our opportunities when we're transacting. ESG is one of the individuals of the technical due diligence team, right? They get involved and they're looking at all three, E, S, and G, in terms of opportunities. Even in the sector as a whole, we're starting to see opportunities or transactions that are being announced where there's a financial compensation, a financial benefit for direct ESG. Some of the larger players, Franco-Nevada has done this. Yeah. Royal Gold recently did this. So it's nice to see that it's becoming a part of the investment mandate. It's not just we will pay you upfront payment and we will pay you X amount per ounce, but they're now incorporating that into their ESG investment mandate. That's something that we'll obviously be doing as well. And look, ESG is a broad spectrum. Gender diversity is an important thing. We're proud of our board for the diversity that it has. Even the transactions that we've announced, these two carbon sequestration opportunities, were both with Indigenous communities. In one case, the Lac Seul First Nation. In the other case, in Alberta, it's with the Elizabeth Métis. So, we're doing a double benefit of green investments with Indigenous communities. So yes, it's something that we're going to keep on ramping up. ESG is fundamentally important to us. We've said that since our IPO. It's not a buzzword for us. It's something that's crucial. In my case, I'm coming from an environmental studies background in geology. So these things really do matter. And not only are we happy to be doing ESG type deals, but we're happy to be getting good returns with those deals. And they're not just for the sake of ESG.
Perfect. Thank you. Time flew by there, Alex. We have to get into the vault though before we end off. And in the vault, it won't be available on YouTube, just on my website, thewealthholderspodcast.ca, and Apple Podcasts and Spotify. But it's mentorship-like questions, nothing related to Star Royalties, but it's about me seeking advice and guidance from my guest. And it's been my favorite part of every interview. So let's get into the vault. Everyone needs that little bit of encouragement. Well said. Exactly. So Alex, thank you for your time. I appreciate it. I really enjoyed the conversation, learning more about the story. But I like letting my guests finish off. So here's your chance to say whatever you'd like to the audience. Just close us off, please.
Sure. Well, thanks, Colin, for having me. It's an honor to speak to you and to your audience about the Star Royalties. I think it's an exciting opportunity to participate in the story. We're just getting started. We're here to build a reputable tier 1 governance company in the royalty and streaming sector. In terms of investment opportunities, I think you're getting access to an experienced and well-connected team, a team that can source and execute on deals. We've got the large pipeline that we've talked about, $200 million plus, and that's everything from gold, silver, green, top-tier jurisdictions, cash flow and near-term cash flow, majority underwriting, majority exclusive. Something we haven't really spoken about, but is valuation metrics. From our point of view, we are the least expensive royalty and streaming company on most metrics, and certainly on all cash flow metrics for 2022. We trade at about a 70 or 75% discount on EV to EBITDA, price to cash flow. these are significant discounts. And I think that there's a re-rate opportunity as we execute on the pipeline and we begin more of our marketing campaign. And you also get access to first mover green advantage. We're going to be doing more green deals in the future. We're looking to announce different partnerships on the green side. So there's a lot going on in the backgrounds, and we're excited to announce it in due time. And we think it's a great opportunity to be a part of it, at these share price levels, especially.
Yeah, perfect. And maybe we'll have you on again. We'll revisit it in a few months.
We'd
Thanks,
love to be
Alex.
back.
I appreciate it.
Thanks, Kyle.